The question often arises, what procedures and controls must companies have in place in order to utilize non-GAAP measures? John White, a partner at Cravath, Swaine & Moore, suggests what should be considered by management as well as the auditors and the board's audit committee when and if non-GAAP adjustments are taking place.
I guess I would start just so we get the basic ground rules. The non-GAAP measures are not subject to ICFR. They're not subject to the audit opinion. Obviously, the underlying financial information is. But they are subject to disclosure controls and procedures. If they appear in a 10K or a 10Q or in a proxy, and we'll come back to proxies in a little bit, and they're also subject to DCP if they appear in an 8K with respect to your earnings release, a 202 8K, or if they show up in a 701 8K where you might have filed it or furnished it in connection with an FD disclosure. And if you have any doubt about the way the words work, the definition of disclosure controls and procedures covers information that is required to be disclosed in reports an issuer files or submits under the 34 Act. And I think we all believe that when we say file or submit, submit covers these furnished documents such as your earnings press release or your FD compliant filings, or your filings under 701 of 8K. So you're under disclosure controls. If you kind of step back and look at the different players that you have to focus on with respect to controls, you've got the disclosure committee, you've got the CEO and CFO and their certifications, you have the audit committee, and you have the auditors. Starting down that list, your disclosure committee obviously covers disclosure controls and needs to have the appropriate procedures within their documented list of procedures that they're following to cover the non-GAAP measures. Your CEO and your CFO have to certify each quarter that you have disclosure controls in place, that you've established them and maintained them, and that they are designed and appropriately, and that they have to then evaluate them. So again, your CEO and your CFO have a statutory role that they have to play with respect to non-GAAP basically every quarter. So what does that mean if you go back to the definitions? I think at the very least, looking at disclosure controls and procedures, you have to have in place something so that non-GAAP information is, to use the magic words, accumulated and communicated to management and the CEO and CFO so that they are allowed to make timely disclosure decisions. Those are all various keywords out of the definition. So remember, you've got to have something in place so that the information is accumulated and communicated to them.